Hey guys, so in the previous video we had a look at current liabilities on the balance sheet. So what we're going to do is we're going to zoom out a bit and we're going to look at the entirety of the liability section on a balance sheet. So far you've looked at your assets. The second half of the balance sheet is your liabilities, and we're going to have a look at that as a whole in this video. So kind of recapping from our previous video, we kind of went over current liabilities. So the first section you're going to get in your liability section is the current liabilities. And the best way to think of this is any expenses that have to be paid out by your business within 12 months or the next fiscal year. So this could be things like your income tax payables or your accounts payable, accrued expenses, salaries, stuff that has to be paid out within 12 months. Your next portion is called the long-term debt. Now, in the previous video in current liabilities, we went over something called the current portion of debt, which is any component of debt that has to be paid out in 12 months. The long-term debt is the exact opposite, and as the name suggests, it's a debt that spans way more than 12 months, which is why it doesn't figure in the current liability section. A good example would be like a mortgage, which is usually paid out in a few decades, and hence it kind of makes up the next component of the liability section. The third section that we have is something called capital stock. Now, imagine you have a business, right? You've put your money into the business, and say you've had a quarter where your sales were down or your numbers were down, so you kind of put a bit more money from your savings. That's your capital stock. So your capital stock is just original money that you've invested and any add-on money that you've invested in the business. Now, the reason it's called capital stock is because the money you've invested is represented by shares of capital stock, which is usually held by the owners, which in this case is you, or any shareholders. The next section that we have is something called retained earnings. Now, let's presume that your company actually does profit, and any profits that you've not paid back to your shareholders as dividends is your retained earnings. So it's not paid out. The best way to think of it is you've got all your profits and then you've deducted anything you want to send out in dividends. What is remaining tends to be your retained earnings. Now, fun thing about retained earnings is it can be viewed as a pool for money from which future dividends can be then paid. You can just use that as a pool, and then you can either bump up the dividends or you can pay it for the future dividends. The next section that you have is something called a shareholder's equity. Now, this is quite simply the sum of investment made in the stock of the company plus any profits and minus any dividends that's been paid out to the shareholders. The easiest way to think of it is you've got your capital stock, you've added your retained earnings, and that should give you a shareholder equity. So you've got your capital stock, and then you take out your retained earnings, which gives you a shareholder equity. Now, the value of your shareholders' equity increases usually when you make a profit. And when you make a profit, obviously your retained earnings goes up, or you sell new stock to investors, which again either increases your capital stock. So there's either a rise in capital stock or retained earnings, which is how you get a higher shareholder value. And the exact opposite is the same as well. If we had a decrease, it usually means you had a loss, which brought down your earnings, or you paid out dividends to the shareholders, which then must have lowered your retained earnings. But anyway, in order to find out your total liabilities and equities, all you do is you add your current liabilities. So your current liabilities, then your long-term debt, let's just see where the stencil is. Yeah, there it is. Long-term debt. And then finally you add your shareholder equity, or if you want to break it down, you add your capital stock and your retained earnings. Either way, same principle. You add your shareholders equity, and that should give you the total liabilities and equity that your company has. Now, if you go back to the initial video, we had an equation saying assets is equal to liabilities plus shareholder equity. A good exercise would be to go to a balance sheet, look at the assets, add up the assets, and then go to liabilities and shareholder equity portion, add them up and see if it matches.